This is the story of Warren Buffett, a man who transformed simple investments into one of the world's greatest fortunes. It's not just a story about money, but about how anyone can learn to invest wisely, build wealth over time, and do it all while keeping their feet firmly on the ground. You don't need to be a genius. You don't need complicated formulas. Just patience, discipline, and a willingness to think for yourself. Warren Buffett was born in Omaha, Nebraska in 1930, right at the beginning of the Great Depression. His father, Howard Buffett, was a stockbroker and later became a congressman. Money was scarce when he was growing up, as it was for most families during those years. But even as a child, Warren was fascinated by numbers, by business, by the idea that money could work for you instead of just you working for money. He bought his first stock at age 11. It was City Service Preferred, and he bought 3 shares for himself and 3 for his sister Doris. He paid $38 per share. The stock fell almost immediately to $27, and he was terrified. But then it rose back to $40, and he sold. He thought he was so clever, making a small profit. But then the stock kept rising, reaching $200. That was his first real lesson in investing. Patience pays off, and selling too early can be costly. Throughout his childhood, Warren was always looking for ways to make money. He delivered newspapers, sold golf balls, worked at his grandfather's grocery store. He didn't do it because his family forced him to work. He did it because he genuinely loved the process of earning, saving, and watching his money grow. By the age of 16, he had saved over $5,000 from various ventures. That may not seem like much today, but back then it was a small fortune for a teenager. He remembers thinking to himself that if he could keep doing this, keep finding ways to make money and invest it wisely, he could become very rich one day. And he was right, although even he couldn't have imagined how right he was. Warren went to the University of Nebraska for his undergraduate degree and then applied to Harvard Business School. They rejected him, which at the time seemed devastating, but that rejection ended up being one of the best things that ever happened to him because it led him to Columbia University, where he studied with Benjamin Graham. Ben Graham changed his life. He was the father of value investing, the author of The Intelligent Investor and Securities Analysis. Graham taught Warren that investing wasn't about following the crowd or trying to predict what stocks would do tomorrow or next week. It was about finding companies that were trading for less than their intrinsic value, companies that the market had overlooked or undervalued. He called this buying stocks with a margin of safety. The idea was simple but powerful. If you buy something worth $1 for 50 cents, you have room for error. Even if you're wrong about some of your assumptions, you'll probably still make money. After finishing at Columbia, Warren returned to Omaha and worked for a while at his father's brokerage firm. So he went to New York to work at Graham's investment firm, the Graham-Newman Corporation. He was thrilled to work directly with his mentor and learned a tremendous amount during those years. But Graham had one rule. He never paid anyone more than $12,000 a year, no matter how well the person performed. He believed that overpaying people would attract the wrong kind of people to investing, people motivated by money rather than the intellectual challenge of finding good investments. Warren respected his philosophy, but when Graham decided to close his firm in 1956, he had to figure out what to do next. He returned to Omaha and started his own investment partnership with money from family and friends. He was 25 years old and he had 7 limited partners who invested a total of $105,000. He put in $100 of his own money. The deal he offered was unusual but fair. He would not charge a management fee but would keep 25% of the profits above a 6% return. If the partnership did not earn at least 6%, he would not earn anything. This aligned his interests perfectly with those of his partners. He would only make money if they made money. Those early years running his partnership were some of the most exciting and formative of his life. He worked out of a small office, really just a guest room in his house. He read everything he could get his hands on: annual reports, financial statements, business publications, anything that would give him an edge in understanding business and finding undervalued opportunities. He spent most of his day reading and thinking, and very little time actually buying and selling. This is something people often don't understand about investing. They think it's about constant activity, about making moves, about staying busy. But the best investing is often boring. It's about finding great opportunities, being patient enough to wait for the right price, and then holding on while the investment pays off. One of his earliest and most successful investments during this period was in a company called American Express. In 1963, American Express became embroiled in a scandal involving a subsidiary that had borrowed money against worthless inventory of salad oil. The company's stock price plummeted, falling from $65 to about $35. Most investors were terrified and sold their stock, but Warren did something different. He went out and observed. He went to restaurants and stores to see if people were still using American Express cards and traveler's checks. And guess what he found? They were. The scandal hadn't damaged the core business. Customers still trusted the American Express brand. The market was panicking over a temporary problem while ignoring the company's fundamental strength. So he invested heavily in American Express, and in the following years, the investment returned several times what he paid for it. That was value investing in action, buying a great business at a bargain price because the market had overreacted to bad news. Another early investment that taught him a lot was Berkshire Hathaway, which ironically started as a mistake. Berkshire was a struggling textile mill in New England, and Warren initially bought stock because it seemed cheap based on Graham's criteria. But textiles was a terrible business, with low margins, intense competition, and constant capital needs just to stay afloat. He continued pouring money into the textile operations, hoping to turn the situation around, but it was like pouring water into a leaky bucket. Eventually, he realized he needed to completely change Berkshire's focus. He began using the cash flow from the textile business to buy insurance companies, starting with National Indemnity in 1967. Insurance turned out to be a much better business model. Insurance companies collect premiums up front and pay claims later, which means they have float, money they can invest in the meantime. This float became the engine that fueled Berkshire Hathaway's growth for decades. They used the float to buy entire companies and to invest in publicly traded stocks. Over time, Berkshire evolved from a failing textile mill into one of the most successful conglomerates in history. Now, let's talk about Warren's investment philosophy in more detail, because that's what most people really want to know. How does he decide what to invest in? What does he look for? The principles he follows aren't complicated, but they do require discipline and patience. First, he only invests in businesses he understands. This may seem obvious, but it's amazing how many people violate this rule. During the dot-com bubble in the late 1990s, everyone was pouring money into unprofitable internet companies with no proven business models, just wild promises about the future. Warren stayed away from almost all of them because he didn't understand how they would make money. People thought he was old-fashioned, that he had missed the boat. Then the bubble burst, and many of these companies went bankrupt, while Berkshire shareholders were protected. He's not saying he's too old to understand technology. He's saying he only invests when he can reasonably predict how a business will perform over the next 10 or 20 years. If he can't do that, he moves on. Second, he looks for companies with durable competitive advantages, what he calls an economic moat. This could be a powerful brand like Coca-Cola, a unique business model like See's Candies, patents, network effects, high switching costs, anything that protects the company from competitors. When they bought See's Candies in 1972, they paid $25 million for a business that was making about $2 million a year in pre-tax profit. People thought he overpaid, but See's had an incredible brand and customer loyalty. People associated See's with quality and gift-giving and were willing to pay a premium price. Over the years, they were able to raise prices regularly, and See's generated enormous amounts of cash that were reinvested in other opportunities. That's the power of a strong moat. Third, Warren wants competent and honest management. He can't manage all the businesses he owns, so he needs to trust the people in charge. He looks for managers who love their businesses, who think like owners, and who are straightforward in how they communicate with shareholders. One of his favorite sayings is that when a management team with a reputation for brilliance faces a business with a reputation for poor economics, it is usually the reputation of the business that remains intact. In other words, a great manager can't save a terrible business, but a great business can thrive even with mediocre management if it has a strong enough moat. Fourth, he is always thinking about price. Even the best business in the world is a bad investment if you overpay for it. This is where the margin of safety comes in. He wants to buy when the price is significantly below his estimate of intrinsic value. How does he calculate intrinsic value? He looks at the cash flows the business will generate over its lifetime, discounted back to the present. It's not an accurate science, and he's often wrong in his estimates, but if he's buying at a substantial discount to his estimate, he has room for error. Fifth, he thinks long-term. They're not trying to make money in the next quarter or the next year. They're trying to build wealth over decades. Their favorite holding period is forever. When they buy a great business at a fair price, why would they sell? They would just have to pay taxes on the gain and then find somewhere else to invest the money, probably at a less attractive price. This long-term orientation is one of the biggest advantages that individual investors have over professional money managers, who are often judged by their quarterly or annual performance. You don't have to report to anyone but yourself, so you can afford to be patient. Let's give some specific investment examples that illustrate these principles. In 1988, Berkshire began buying Coca-Cola stock. Warren had known Coca-Cola for decades. He bought his first Coke when he was 5 years old and has been drinking it ever since. But he didn't really focus on it as an investment until the stock price fell in 1987 after the market crash. He looked at Coca-Cola and saw a company with the most valuable brand in the world, selling a product that people loved in almost every country on Earth. The economics were beautiful. The concentrate is cheap to make, and Coca-Cola is paid for it by the bottlers, who then bear the capital costs of manufacturing and distribution. The company was generating enormous amounts of free cash flow, which it used to buy back shares and pay dividends. He could easily imagine Coca-Cola being even more valuable in 10, 20, 30 years. So they bought about 7% of the company for $1.3 billion. Today, that investment is worth many times what they paid. Plus, they have received billions in dividends over the years. And Warren still thinks Coca-Cola is a great business. Another example is Apple, although he came to it much later in his career, which shows that you're never too old to learn. Initially, he avoided tech stocks, as mentioned, because he couldn't predict their future with confidence. But he started buying Apple stock in 2016 when he was already in his mid-80s. Why Apple? Because by then, he had come to see Apple less as a tech company and more as a consumer products company with an incredibly loyal customer base. People love their iPhones. They're willing to pay premium prices, and they keep coming back for the next model. Apple has created an ecosystem that's hard to leave once you're in it. Your photos, your messages, your apps, everything is integrated. That's a powerful moat. So even though he came late to the party, they eventually built a position worth over $100 billion at its peak. That's now one of Berkshire's largest holdings. Now, let's talk about some of the mistakes he made, because you can learn as much from failures as from successes. One of his biggest mistakes was buying the Dexter Shoe Company in 1993. He paid about $400 million for it, and he paid in Berkshire stock, not cash. The shoe business turned out to be far more competitive than he had anticipated, with manufacturing shifting overseas. Dexter eventually became worthless. But the real mistake wasn't just buying a bad business, it was paying for it with Berkshire stock. Those shares he gave away are now worth billions of dollars. That's what he calls a thumb-sucking mistake, just sitting there doing something stupid. Another category of mistake is what he calls sins of omission, opportunities he failed to seize. He should have bought more of certain stocks when they were cheap. He should have bought Google and Amazon when he had the chance. He understood Google's business model and how powerful it was, but he didn't pull the trigger. These missed opportunities cost Berkshire and shareholders billions in potential gains. But you can't keep dwelling on these things. You have to accept that you will make mistakes, learn from them, and move on. One thing Warren wants to emphasize is that successful investing doesn't require you to be extraordinary. You don't need a high IQ, you don't need insider information, you don't need to spend all day watching stock quotes or listening to market experts on television. In fact, most of that noise is counterproductive. What you need is a solid intellectual framework for making decisions and the emotional discipline to follow your framework when others are panicking or getting greedy. This brings us to one of his favorite concepts, Mr. Market. Ben Graham used to tell a parable about an imaginary business partner named Mr. Market. Every day, Mr. Market shows up at your door and offers to buy your share of the business or sell his share. Sometimes Mr. Market is optimistic and offers a high price. Other times, he is pessimistic and offers a low price. The key insight is that you don't need to negotiate with Mr. Market every day. You can ignore it when its prices are silly and take advantage of it when its prices are attractive. Mr. Market is there to serve you, not to guide you. Many investors forget this. They watch the market every day and let its mood swings dictate their actions. They buy when everyone is buying and prices are high because they feel confident and excited. They sell when everyone is selling and prices are low because they feel scared and uncertain. This is exactly the opposite. You should be greedy when others are fearful and fearful when others are greedy. The 2008 financial crisis was a perfect example of this principle in action. The crisis began with problems in the housing market and subprime mortgages, but quickly spread throughout the financial system. Lehman Brothers collapsed. AIG had to be bailed out. The stock market plummeted. People were terrified, convinced they were heading for another Great Depression. Money market funds were at risk of collapsing. The entire system seemed on the brink of collapse. It was frightening, he doesn't lie, but he also knew it was an incredible opportunity. Big businesses were being sold at bargain prices because of the widespread panic. So in the midst of the crisis, Warren invested billions of dollars. They bought preferred stock in Goldman Sachs and General Electric, businesses that gave them attractive dividends, and warrants for common stock. They bought Burlington Northern Santa Fe, the railroad company, for $26 billion in the largest acquisition of all time. People thought he was crazy, but he knew that America would survive and prosper, and he knew that railroads were an essential part of the economy with a strong competitive position. These crisis investments ended up being extremely successful. Warren wants to give some practical advice if you are just starting out as an investor. First, live below your means and save consistently. It doesn't matter if you're saving $50 a month or $5,000 a month. The important thing is to develop the habit and make it automatic. Pay yourself first before spending money on anything else. Second, avoid debt, especially high-interest debt like credit cards. Debt is the enemy of wealth building. If you are paying 18% interest on credit card balances, you are digging yourself a hole that is very difficult to get out of. Third, educate yourself. Read everything you can about investing in business. Read annual reports. Read biographies of successful investors and entrepreneurs. Read newspapers and magazines to understand what is happening in the economy and in different industries. The more you read, the more knowledge you accumulate, and that knowledge builds up over time, just as investment returns build up. Fourth, if you're unsure how to pick individual stocks, or if you don't have the time or inclination to do the research, just buy a low-cost index fund. Warren recommended this many times. Put your money in an S&P 500 index fund and leave it there for decades. You'll outperform most professional investors after your fees are deducted. In fact, he made a bet on this. In 2007, he bet $1 million that an S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. The hedge fund manager who took the bet selected 5 funds of hedge funds, so they were really comparing the index fund to hundreds of individual hedge funds.
At the end of the 10-year period in 2017, the S&P 500 index fund had returned 125.8%, while hedge funds had returned only 36.3%. The index fund crushed them, even though the hedge funds were managed by highly paid professionals who were supposedly using sophisticated strategies. The problem was that the hedge fund fees ate up most of the returns. Fifth, be patient and think long-term. Don't check your portfolio every day. Don't panic when the market crashes. Don't get too excited when the market soars. Just keep investing consistently, keep reinvesting your dividends, and let compound interest work its magic. Albert Einstein supposedly called compound interest the eighth wonder of the world, and he was right. If you invest $10,000 and earn 10% a year, in 10 years, you will have about $26,000. In 20 years, you will have about $67,000. In 30 years, you will have about $174,000. In 40 years, you'll have about $452,000. The same amount of money, the same rate of return, but the later years produce much more growth because you're earning returns on your returns. That's the power of compounding, and that's why starting early and staying invested for a long time is so important.
Warren also notes some common mistakes people make. One is trying to time the market, trying to predict when it will go up or down. Nobody can do that consistently. Not him, not professional investors, nobody. The market is too complex and heavily influenced by unpredictable factors. Yes, sometimes he makes broad statements, like he did during the financial crisis when he said to buy American businesses, but he's not trying to predict what the market will do next week or next month. He's making a general observation that stocks are cheap relative to their long-term value. That's very different from timing the market. Another mistake is following the crowd or listening to advice from friends, relatives, or television personalities. Just because someone you know made money on a stock doesn't mean it's a good investment for you right now. Maybe they bought at a much lower price. Maybe the situation has changed. Maybe they just got lucky. Do your own research and make your own decisions based on your own understanding and analysis. A third mistake is letting emotions drive your decisions. Fear and greed are the two emotions that cause most investment mistakes. When the market is roaring and everyone is making money, greed takes over and people start taking excessive risks, buying things they don't understand, paying outrageous prices. Then, when the market crashes, fear takes over and people sell everything, often at the worst possible time. You need to be able to control these emotions and act rationally, even when everyone around you is losing their minds. A fourth mistake is focusing too much on short-term results. If you buy a stock today and it goes down tomorrow, that doesn't mean you made a mistake. If you buy a stock today and it goes up tomorrow, that doesn't mean you made a smart decision. Short-term price movements are mostly random noise. What matters is whether you bought a good business at a reasonable price. If you did, be patient and let the business create value over time. Warren also wants to talk about integrity, which has been a cornerstone of his career and his life. He has seen many people make money through questionable or unethical means. Perhaps they traded with insider information. Perhaps they manipulated financial statements. Perhaps they took advantage of clients or employees. Some of them got away with it, at least for a while. But many were caught and faced serious consequences. And even those who weren't caught had to live with themselves, knowing what they had done. It's not worth it. Making money is important, but maintaining your reputation and integrity is more important. It takes 20 years to build a reputation and 5 minutes to ruin it. If you keep that in mind, you'll do things differently. At Berkshire Hathaway, they have always tried to operate with the highest standards of integrity. They treat their shareholders as partners. They communicate honestly, even when they have made mistakes or had disappointing results. They don't use accounting tricks to make their numbers look better than they are. They allocate capital based on what will create the most value in the long term, not based on what will make next quarter's profits look good. This approach has served them well. Their shareholders trust them, their employees are proud to work for them, and their business partners want to do business with them. That trust is their most valuable asset, more valuable than any particular business or investment.
As he got older, Warren spent more time thinking about legacy and giving back. He and his recently deceased partner, Charlie Munger, always lived relatively modestly despite their wealth. Warren still lives in the same house he bought in 1958 for $31,500. He doesn't own a yacht or a vacation home. He drives to work. He eats McDonald's for breakfast. Some people find that strange for someone who has been one of the richest people in the world. But material possessions beyond a certain point don't make him happy. What makes him happy is the game of investing, the intellectual challenge, working with people he likes and respects, and knowing he's building something that will last beyond his lifetime.
He is pledged to donate 99% of his wealth to philanthropic causes, primarily through the Bill and Melinda Gates Foundation and through foundations run by his children. He believes that people who have been as fortunate as he has, who have benefited from living in a society that rewards the allocation of capital, have an obligation to give back. He won the ovarian lottery by being born in America at a particular time with particular talents that happened to be valued in this society. If he had been born at a different time or place, or if he had different talents, his life would have been completely different. So he doesn't take credit for all of his success. Much of it was luck. Looking back on his life and career, Warren feels incredibly fortunate. He has been able to do what he loves every day, working in a field that challenges him intellectually and allows him to continue learning and growing even now in his 90s. He has worked with wonderful people, many of whom have become close friends. He was married twice to women he loved deeply and has 3 children and many grandchildren and great-grandchildren who bring him joy. And he managed to create enormous wealth, not only for himself, but for the thousands of shareholders who entrusted him with their money over the decades. If Warren could give one last piece of advice, it would be this: invest in yourself. Your most valuable asset is not your car or your house or your investment portfolio. It's you, your knowledge, your skills, your character, your relationships. Whatever you invest in developing yourself will pay dividends for the rest of your life. Read voraciously, learn continuously, develop good habits, treat others well, remain curious and humble. These things will serve you far better than any hot stock tip or get-rich-quick scheme. And remember that success in investing, like success in life, is not about being perfect. It's about making more good decisions than bad ones, learning from your mistakes, and staying in the game long enough for compound interest to work its magic. You don't have to be brilliant. You don't need to be lucky. You just need to be sensible, patient, and disciplined. The story of Warren Buffett and the lessons he learned can help anyone on their own journey, whether in investing, business, or life more broadly. The principles he has followed throughout his life are straightforward. Buy quality at a reasonable price, think long-term, stay within your circle of competence, maintain your integrity. They are not complicated, but they work. They have worked for him for over 70 years, and they can work for you too. Warren Buffett has always emphasized the importance of learning from others. He spends hours every day reading, not just financial reports, but also biographies, history, science, anything that can expand his understanding of the world. He says that knowledge accumulates like compound interest. Every single thing you learn today makes it easier to learn something new tomorrow. And over decades, this accumulation of knowledge becomes a huge competitive advantage. One of the questions people often ask Warren is, what is the best investment someone can make? And his answer is always the same: invest in yourself, develop your skills, learn to communicate well, both in writing and speaking, learn to think critically, learn about the world around you. These investments in yourself will pay dividends for the rest of your life, and no one can take that away from you. The market may crash, your company may fail, but what you have learned, the skills you have developed, the character you have built, these things remain with you forever. Warren also talks about the importance of choosing the right people to have around you. He says you should look for 3 qualities in people: intelligence, energy, and integrity. And if they don't have the third, the other 2 will kill you.
An intelligent and energetic person without integrity is dangerous. So choose your business partners, your friends, even your spouse carefully. The people you spend time with will shape who you become. Another interesting aspect of Warren's approach is his attitude towards money. Despite being one of the richest people in the world, he has never let money fundamentally change who he is. He still lives in Omaha, still eats at the same local restaurant, still drives his own car. He's not trying to impress anyone. He's not trying to prove anything. He simply lives according to his values. And one of his core values is that accumulating money for its own sake is not the goal. The goal is to do something meaningful with your life, to contribute to society, to leave the world a little better than you found it. Warren often tells a story about how he thinks about wealth. He says that if you had the ability to buy any car you wanted, but on the condition that this would be the only car you would have for the rest of your life, how would you treat that car? You would keep it in the garage, you would change the oil religiously, you would drive carefully, you would protect it because you knew it had to last. Well, you only have one body and one mind for your entire life. There's no way you can get a new body at 65 like you can with a car. So take good care of the body and mind you have. Don't abuse them. Don't neglect them. Invest in them. This philosophy of taking care of oneself extends to making sound decisions in all areas of life. Warren has avoided addictions. He doesn't smoke, he drinks in moderation, he takes care of his mental health by maintaining a positive attitude and surrounding himself with supportive people. He understands that to succeed in the long term at anything, including investing, you need to be around to reap the rewards, and that means taking care of yourself. One of the most remarkable things about Warren Buffett is his honesty about his limitations. He freely admits when he doesn't know something. He freely admits when he's made a mistake. That honesty isn't weakness, it's strength. Many people, especially successful people, feel they need to pretend they know everything, that they never make mistakes. But that leads to bad decisions because you're not dealing with reality. Warren has always dealt with reality, no matter how uncomfortable it might be. If an investment isn't working, he acknowledges it. If he missed an opportunity, he acknowledges it, and then he learns from it and moves on. This ability to face reality honestly also applies to how Warren thinks about the future. He doesn't make predictions about what the stock market will do next year. He doesn't try to predict interest rates or exchange rates or commodity prices. He knows those things are impossible to predict with any degree of accuracy. Instead, he focuses on things he can assess: the quality of a business, the strength of its competitive advantage, the integrity of its management. These are things that can be analyzed and understood, even if not perfectly. Warren also has an interesting perspective on risk. Many people think that investing in stocks is risky and investing in bonds is safe, but Warren sees things differently. For him, risk is not about short-term volatility. Risk is about the possibility of permanent capital loss. A stock can go up and down in value in the short term, but if you own a great business bought at a good price, the probability of permanent loss is low. On the other hand, if you buy long-term bonds with low yields and inflation rises, you will suffer permanent loss of purchasing power. So what seems safe may actually be risky, and what seems risky may actually be safe, depending on the circumstances. This nuanced understanding of risk is one of the reasons Warren has been so successful. He doesn't follow conventional definitions or conventional thinking. He thinks for himself. He questions assumptions. He looks beyond the surface to understand what is really going on. And that has given him a huge advantage over investors who just follow the crowd. One final lesson that Warren always tries to convey is the importance of gratitude. He feels tremendously grateful for all the opportunities he's had, for the people who have helped him along the way, for the luck of being born in a time and place where his specific talents were valued. He never considers himself to be entirely self-made. Yes, he worked hard. Yes, he made smart decisions, but he also got very lucky. And recognizing that luck, being grateful for it, keeps him humble and grounded. That humility is one of the most appealing things about Warren Buffett. Despite all his success, despite all his wealth, he has never become arrogant or presumptuous. He still loves to learn. He still asks questions. He still admits when he is wrong. He treats everyone with respect, from the CEOs of the largest corporations to the janitor in the Berkshire Hathaway office. He understands that every person has value, that every person has something to teach.
When you look at Warren Buffett's life and career as a whole, what emerges is not just the story of a great investor, but the story of a person who lived according to his principles. He identified what was important to him early in life: freedom, independence, the intellectual challenge of investing, doing meaningful work, taking care of the people he cares about. And then he structured his life and career to maximize those things. He didn't pursue money for its own sake. He didn't pursue status or fame. He pursued what truly mattered to him, and money and recognition came as byproducts. That is perhaps the most important lesson of all. Success is not about accumulating the most money or achieving the highest status. Success is about living a life that is true to yourself, that is aligned with your values, that makes you happy, and that contributes positively to the world around you. Warren Buffett achieved that kind of success, and that is why he is admired not only as an investor, but as a human being. Today, at over 90 years old, Warren continues to work, not because he needs the money, but because he loves what he does. He continues to look for investment opportunities. He continues to advise and mentor young entrepreneurs and investors. He continues to read voraciously and learn new things. And he continues to be an example of how to live a well-lived life. The story of Warren Buffett teaches us that greatness doesn't come from doing complicated things. It comes from doing simple things consistently well over a long period of time. It comes from having clear principles and following them even when it's difficult. It comes from treating people well, keeping your word, living with integrity. It comes from being patient, thinking long-term, and not being influenced by the mood swings of the market or the crowd. If you apply the principles that Warren Buffett followed in your own life, in your own investments, you may not become a billionaire, but you will become a better investor, a better thinker, and most likely a happier and more successful person. And in the end, that's what really matters. It's not about having the biggest bank account. It's about living a life you can look back on with pride, a life that made a difference, a life that was worth living. Warren Buffett built more than a fortune. He built a legacy of wisdom, integrity, generosity, and common sense. And that legacy will continue to inspire and educate investors and ordinary people for generations to come. This is the true measure of success, not what you accumulate for yourself, but what you leave behind for others. And by that measure, Warren Buffett is truly one of the great success stories of our time.